What happens to the promissory note after it's monetized? You sign a loan. The bank keeps the note. But have you ever wondered what happens next? In this video, we trace the life of a promissory note after it's monetized, revealing the hidden financial pathways, securitization, and how banks use your signature to create credit, profit, and enforce debt in your name. Once your promissory note has been monetized by a financial institution through the Federal Reserve discount window, it no longer remains merely a promise to repay. It becomes a negotiable financial asset, capable of being traded, securitized, sold, or pledged, often without your knowledge. This transformation is made lawful by UCC Section 3-301 and Section 3-302, which define how a holder in due course may claim rights over the instrument, irrespective of original parties or consideration. Upon being deposited, your note is typically 1. Book-entered as a receivable asset on the institution's ledger. 2. Endorsed for negotiation, which can occur with or without recourse. 3. Securitized, often bundled with other notes into asset-backed securities (ABS), such as mortgage-backed securities, MBS, or credit card receivable trusts. 4. Sold or assigned to investors, hedge funds, or secondary market entities via Uniform Commercial Code, UCC Article 9, governing secured transactions. 5. This entire cycle is legal and normalized in commercial banking, but few consumers realize that the note is no longer in possession of the originating lender. This matters because under UCC Section 3-309, enforcement of a lost, destroyed, or stolen instrument requires strict proof of ownership and chain of custody, yet most foreclosures or debt claims never provide the original note. Moreover, by endorsing the note in blank, borrowers have unknowingly created a bearer instrument under UCC Section 3-205b, which allows anyone who holds the note to enforce it without proving they are the rightful owner. This creates dangerous ambiguity, particularly in debt collection and foreclosure litigation. The end result: you pay a second time for something that was already monetized and funded at origination. The note created the money. The repayment becomes a redundant financial obligation. This is akin to a store issuing a gift card and then asking the purchaser to pay again at the register after using the card, except this is done at the scale of national banking and consumer credit. This is not a theory. It is established by financial accounting practices such as FAS 140, which details the recognition of transferred financial assets. Once the note is sold or securitized, it is removed from the lender's books, proving they no longer hold a financial risk or receivable. Yet they often continue to collect or delegate collection as if they do. Footnote: this section reveals how monetized promissory notes are securitized, sold, and derecognized, yet borrowers are still pursued for payment, despite the note having already generated funds at inception.